John. I'm really looking forward to speaking with you today about how to help clients with estate planning, particularly with small business owners. Today we're going to be talking about estate freezes and family trusts, particularly in light of the changes that have come about to tax legislation to do with small businesses. So in order to get rolling, why don't we talk a little bit about estate freezes? Can you remind us again what an estate freeze is?
Well, an estate freeze is typically something that parents in a family business will enter into. Mom and or dad are shareholders. They own common shares of a business. And they're concerned about the future capital gains tax on those shares and maybe limiting the growth. So what they do is they exchange on a tax-deferred basis the shares that they own for preferred shares that are frozen in value. They'll typically retain voting control and have dividend privileges in those shares, but they're fixed value preferred shares. New common shares are issued to the younger generation or to a trust, which we'll get to, and those shares will reflect all the future growth in the value of the business. So we can talk about a simple example of a parent here in this case that owns $4 million worth of shares in a small business we'll call OpCo. Those shares have no ACB, no paid up capital, just nominal amounts. And they're concerned, as I say, about the future growth in the value of those shares and maybe future taxation on those shares. So that would be a typical starting point.
Okay. Can you give us an example of how you might walk them through an estate freeze?
Right. So how that might transpire is, as you can see, the parents now own preferred shares. They've acquired them on a tax-deferred basis, so they're not paying any tax at the time they acquire the shares. They're frozen in value at $4 million, which was the value of the shares at the time of the freeze. They're common shares. They've got voting control and dividend privileges, as I said. And what we've done with the common shares in this example is use a family trust, which is, I think, the way that it's done most often these days. A family trust will own the common shares. It will reflect all the future growth in the value of the business. Those shares are worth nothing today, but they're going to grow over time. And the beneficiaries of the trust can be anyone the parent wants to be a beneficiary. So typically it would be the children, sometimes the grandchildren, sometimes even their spouses. Because it's a discretionary trust, no one is entitled necessarily to get shares at the end of the day. So the more beneficiaries you have, the more flexibility you have in ultimately deciding who gets those shares. It's very common in this day and age as well to include a holding company. So a family holding company can also be a beneficiary of the trust. So you can make it very flexible, and typically that's what we recommend, is that it be set up in that way.
Okay. And what would be some of the advantages of an estate freeze?
The main advantage and typically the motivation for doing a freeze in the first place is tax deferral. So if the parent in this case didn't do a freeze and the business continued to grow in value, obviously the capital gains tax payable at the end of the day would get higher and higher in the hands of the parent. So the idea of the freeze is to defer that tax to the next generation. So that's usually the motivation for doing it. Another benefit is it's a tax efficient way to bring children into the business as shareholders. They're acquiring shares that have nominal value, so it's easy for them to buy in at a very low price. And so it's tax efficient from that point of view as well.
So you mentioned a family trust in your example. What role would the trust play in estate freeze?
Well, I would say the main advantage of any trust is that it provides control and it provides flexibility. So in our example, the parents, let's say, are the trustees. They get to make all the decisions while they're still alive and competent. They've got flexibility in deciding who ultimately receives the shares out of that trust. So they might, for example, decide that this son or this daughter is a suitable business successor. They're the person that should get the shares out of the trust. So they can decide at a later date who gets how many shares and in what proportions. So control and flexibility, I would say, are the two main advantages of using the trust.
And what would be some tax implications of making use of a trust like this?
The main thing people need to realize with a trust is there's what's called a deemed disposition every 21 years. So if nothing happens for 21 years, the shares are still sitting in the trust and they've grown in value over that time. And if nothing is done, there's a taxable event that happens on the 21st anniversary. And usually the best way to deal with that is to make sure the shares are distributed before the 21st anniversary. So in effect, a trust has a 21-year lifespan. Otherwise, you're going to have tax implications you weren't expecting. So that's number one. Number two, and this is an advantage of a trust, although the government has talked about making changes to this rule, they have not done so as of yet. If a third-party purchaser comes along, which often happens in a family business, they don't always go down to the next generation. If a third-party purchaser comes along, the trust can sell the common shares that it owns to the third party, And the capital gains exemption, if it's available, can be shared amongst the beneficiaries of the trust. So that's a huge advantage in many cases.
Given that 21-year rule, does that impact the timing of implementing a trust like this?
Well, it does, because, for example, if your children are 2 and 4 years old and you set up a trust for them, they'll only be 23 and 25 at that anniversary date, which is still a very young age. So I would say it's better in most cases to wait until the children are a little bit older, and also the age of the parents matters. Typically, again, it depends on the circumstances, but a 40-year-old parent maybe is too young to do a freeze, whereas someone in their 60s may be just the right age. Someone in their 80s is probably too old because they're not going to live long enough anyway, and the tax deferral advantage is not as great. So the age of the parents and the age of the children are factors, for sure.
And state freeze often brings about conversations about shareholder agreements. At what point would you say it would make sense to start bringing a shareholder agreement into a family business?
If, for example, if parents own shares of a business, you don't often see a shareholders agreement in that case. Sometimes you do, more often you don't. What I would say is, though, as soon as you involve another generation in share ownership, that's the time to do a shareholders agreement, and you do it at the same time that the estate freeze is done. Everything's done at the same time. You get that agreement done.
Okay. And what are some of the things that people should be thinking about when it comes to this shareholder agreement?
Well, a lot of people will be familiar with agreements and what they typically say, and in many cases family agreements are no different. We'll get to some differences in a minute, but they will contain things that people are used to seeing, like buy-sell consequences on death, disability. If anybody in the family owns shares and they die, what happens? If they become disabled, what happens? If they have marriage breakdown, what happens to those shares? They become bankrupt. All sorts of buy-sell things can be provided for in these agreements. Rights of first refusal, third-party offers. If somebody wants to buy the shares of the family business, there should be something in there dealing with third-party purchasers. Those are typical things that you would see in any shareholders agreement.
Are there certain considerations that apply specifically to shareholder agreements for a family business that would be different from those more standard shareholder agreements?
Yeah, for sure there are differences, significant ones, I think. One key consideration is if one of the parents dies, are their shares going to be purchased or are they going to be gifted to members of the family? We'll often see, for example, where some children are active in the business and some aren't, and the parents are trying to figure out a way to balance the estate distribution amongst all of their kids. Sometimes the best way to do that is to have mom and dad's shares purchased on death, using insurance, which generates cash that can be used for the benefit of other beneficiaries. Disability buyout. It would be normal, and I guess in a shareholders agreement that doesn't involve family, to have a disability buyout. If someone becomes disabled, the other shareholders should at least have the option to buy the shares of the disabled party. In a family business, for the older generation at least, you probably wouldn't have a disability buyout. You wouldn't want to buy out your disabled father. There'd be really no point in doing that in most cases. You might have dividend distribution policy within the agreement, because perhaps the parents are no longer active in the business, but they own shares. They may have discretionary dividend privileges, but maybe there should be a policy embedded in the shareholders agreement acknowledging that mom and dad are entitled to dividends because they're going to need them for their own lifestyle purposes. Compensation policy. Should a member of the family get more money for doing their job than an arm's length person with the same level of experience would get? Maybe not. So maybe there should be compensation policy that says if you're a member of the family and you have certain job level and certain experience, you're going to get paid the same as if it was a third party with the same responsibilities and experience. That's something a family agreement could provide if that's what the family wanted. Share valuation is a huge issue with family shareholders agreements because the CRA has the ability to challenge the valuation that might be determined between family members if one person within the family is selling to another. So they need to have really good methodology for determining share values, which limits the likelihood of the CRA challenging the purchase price. So those are all things that may be more important in a family shareholders agreement than in other agreements.
Some advisors could definitely experience some resistance from business owners around, particularly family business owners, around putting a shareholders agreement in place? You know, oh, we don't need one, we're family. What would you recommend advisors do to encourage these families to implement?
That's a common objection where parents will say, or family members will say, well, we're family, we love each other, we'll work it out. We don't need an agreement. Well, my feeling is quite the opposite. I think because they're family, they especially need an agreement, because family dynamics can play such a significant role in all of these things. And while mom and dad are alive and in control of things, maybe nothing bad is going to happen, or at least they're in control of what happens. But if mom and dad are deceased or disabled, unable to exert their normal influence, that's when the problems can arise. And so I think maybe one thing that financial advisors, insurance advisors can do is do what-if scenarios with the parents, with the older generation. They'll need to understand better perhaps how well their kids get along or will get along if there's nobody wielding influence over them. Typically, good insurance advisors are the best positioned professionals to motivate clients to act. Lawyers won't do it. Accountants won't do it. They're not very good at motivating their clients to do things. And in some cases, they feel it's unprofessional to motivate their clients to do things. Insurance advisors are typically wired to motivate their clients, and they should do that. And one of the ways to do it is with what-if type scenarios.
When we were talking about family trusts earlier, you'd mentioned the multiplication of the lifetime capital gains exemption. What is the capital gains exemption, and how does someone qualify for using it?
Well, the exemption is basically there to provide relief from capital gains for individuals that own certain types of businesses. So small business corporations that carry on an active business, farming corporations, fishing corporations. The idea is that there's a benefit being provided to entrepreneurs when they sell their shares. There's an exemption available to them if they meet certain tests. And essentially the general rule is that at the time shares are sold or deemed to be disposed of on death, all or substantially all of the assets of the corporation have to be used in an active business carried on primarily in Canada. That sounds simple. The actual definition in the Income Tax Act is anything but simple. But generally what we're looking for when we say all or substantially all is at least 90% of the assets of the business have to be used in an active business. There's also a test that for the 2 years preceding a sale, 50% of the assets have to be used in that way. So basically what we're doing is looking at the balance sheet of a corporation, looking at what kind of assets it has, and determining whether the exemption is available or not. The other thing I want to mention is it's only available to individual shareholders. So if a holding company, for example, owns shares of an opco and the holding company sells shares, there's no capital gains exemption available to the holding company. So the exemption is only available to individuals.
Well, it sounds like planning ahead is a really important component of figuring out the capital gains exemption. How much is the exemption?
Well, the exemption currently is around $867,000. That's an indexed amount, and for a number of years now it's been indexed annually. That number is the 2019 number. The 2020 number will be adjusted upwards a little bit, I'm sure. Originally, the exemption was $500,000, and that's when it was introduced in 1985. At that time, a lot of tax people, professionals, felt that this was just a temporary measure that the government was introducing, and for most years thereafter, for many years thereafter, there was an assumption that it was going to disappear. Well, quite the opposite has happened. It's become a fundamental part of the tax system, I would say, and it's unlikely to disappear. So as I say, the exemption is now over $860,000. That's tax savings in the range of $225,000 on a person who's fully utilizing that exemption. Depends on the province you live in and your personal tax rate, but about $225,000 worth of tax savings right now.
Well, that's not an insignificant amount. What can clients do to ensure that their shares are eligible for the exemption?
Well, the best thing they can do is make sure that the assets that are inside their corporation, their business corporation, are used in the active business. And their own advisors, especially their accountants, should be helping them make sure that the asset mix in their operating companies is appropriate. If they start to accumulate excess funds, for example, cash is typically not an active business asset. it's usually a good idea, for example, to use a holding company, to pay that cash up to a holding company as a tax-free dividend. Certain structuring of the shares has to be done in a way to make sure that the exemption continues to be available. But basically what you're trying to do is keep passive assets off the balance sheet of your operating company, and that includes life insurance policies too. So a permanent policy with cash surrender value is a passive asset that normally should not be inside an operating company for capital gains exemption purposes and other purposes as well.
Well, speaking of passive assets, I understand that there are some newer passive income rules in place now. So what are those and how are they working?
Okay, well, these rules, you're right, these are new rules that are in place. They originate actually with tax proposals that were made by the Minister of Finance in 2017 in the middle of the summer when people weren't really paying a whole lot of attention to tax policy. There was quite a bit of resistance to these changes, and what we have now is really a watered down version of the proposals that were made in July of 2017. And what these rules essentially do is provide some limitation on the amount of passive income that a company can earn while still getting access to the small business deduction, the low rate of tax on small business income. People are likely familiar with the small business deduction. Essentially what that means is for a private company carrying on business in Canada, they get a reduced tax rate on the first $500,000 of active business income. And that tax rate might be in the range of 11 or 12 or 13%, somewhere in that range, depending on the province. The passive income rules will reduce that $500,000 small business deduction. So if you've got passive income that's more than $50,000 in a year, your small business deduction is reduced accordingly. So instead of having access to the low business rate on $500,000 of income, if you have enough passive income, you may only have access to the small business deduction on $400,000 of business income, depending on the level of your passive income. If you have $150,000 of passive income in a year, the small business deduction is eliminated altogether. So it's a sliding scale, in other words. And the client's accountants are the ones that are going to have to keep track of all of this. And it's an important planning problem that small business owners have now.
Absolutely. Are there any aspects of these passive income rules that specifically impact family businesses different from other businesses?
Well, there's one little quirk that I stumbled across in a client file one time, and that is, if you and I, as arm's length parties, we're not related to one another, if we each had a holding company, and our holding companies were 50-50 shareholders in an operating business, whatever passive income you might earn in your holdco is of no relevance to me, and it doesn't matter. It doesn't affect me at all. And likewise, if I have income in my holdco, it doesn't affect you. But if we were brother and sister, if we were siblings, we're not at arm's length. And what that means, we're associated for the purposes of the Income Tax Act. So that rule that I talked about, where you have more than $50,000 of passive income in a year, in our example of for brother and sister, our income is aggregated for that purpose. So all of a sudden, the amount of passive income you're earning in your company is indirectly affecting me because our operating company now is paying a higher rate of tax. So that's just an interesting wrinkle that affects family business that doesn't affect individuals that deal at arm's length.
I understand these passive income rules do not impact corporate-owned life insurance.
That's right. So the rules specifically exclude earnings inside an exempt life insurance policy from being considered passive income. So they will not in any way affect a company's access to the small business deduction. So that creates opportunities for corporate-owned life insurance, obviously, because we've got the ability to take funds that might otherwise be earning passive income that would affect a company's eligibility for the small business deduction, move it into an exempt life insurance policy, and take it out of that whole equation. Ideally, you're doing that in circumstances where there's a pre-existing insurance need. It's just an additional benefit you have with corporate-owned insurance, and it's all part of a balanced approach. There's lots of other planning strategies that tax advisors will have in terms of dealing with these rules, but clearly there's an opportunity here for corporate-owned insurance. There was a specific carve-out of the rules when the Department of Finance introduced it. We always discourage people from putting too much of a marketing spin on that, because if the Department of Finance gets the feeling that this advantage is being oversold, they can change the rules at the drop of a hat. So we always try to take a modest approach to it and say, yeah, there should be a pre-existing insurance need, but assuming there is, here's a real opportunity to use the benefits of exempt life insurance.
Mm-hmm. So it does impact capital gains exemption, but it isn't impacted by the passive income rules.
It does impact the capital gains exemption depending on where the policy is owned. And so there are lots of planning strategies you can use for owning corporate-owned insurance and other passive assets in a separate holding company, for example, while still maintaining eligibility for the capital gains exemption. It usually depends on the tax advisors structuring the companies in a certain way to make sure you've got all those advantages.
What role can charitable giving play in planning for business owners and high net worth individuals?
Yeah, we basically meet a lot of business owners, particularly baby boomers who have accumulated a lot of wealth. Maybe they're in their 60s or even older, and they want to give back. And they've got large family enterprises. Their children are going to be well taken care of. And typically in those sorts of circumstances, philanthropy becomes part of their estate plan. And so it's not an isolated event, really give money away, although it can be. They can certainly do that. But more often they're looking for something more long-lasting. They want to leave a legacy, and it becomes part of their estate planning. It becomes part of their long-term business and family succession planning.
What are some common ways of using life insurance as a way of allowing individuals and business owners to achieve those philanthropic objectives?
Well, there's many ways of doing that, some simple, some not so simple. And most people will be aware of the very simple options, such as have a charity own a policy. If an individual pays the premiums under that policy, it qualifies as a charitable donation. You get a credit for that. Alternatively, you can own a policy in your own name, designate a charity as beneficiary. It might be a family foundation, or it might be an operating charity that you favor. And on death, the death benefit is paid directly to the charity, and there's a tax receipt given for that. So those are very simple planning strategies that can be used. There are some more sophisticated ones. For example, a holding company that owns publicly traded securities can give some of those securities to a charity. I think people will be aware there's no capital gain when you donate public shares. So the holding company would realize a capital gain on that gift, but it would be entirely tax-free. At the same time, there's a capital dividend account credit that's available to the corporation in those cases, because a corporation gets a CDA credit for the tax-free portion of capital gains. In this case, the tax-free portion would be the entire gain. And quite often, what the shareholder will do is buy insurance as a way of replenishing the amount of that gift in the holding company when they die. So that's one example. Another example is even, I guess, more sophisticated one. People are often looking for ways to donate private company shares, let's say to a family foundation. There are strategies where in the will, the business owner says, I'm going to donate X number of preferred shares of my business to a foundation. Maybe it's 10% of the shares or whatever it might be. There is a capital gain on that because they're not publicly traded shares. But the estate, in fact, there's the donation can be used, the credit can be used in the estate or in the year that the individual dies to reduce tax liability, or even the year before they die. The value of those shares can be taken as a charitable credit. But what we suggest is, in many cases, if there's insurance inside the corporation, having gifted those shares to the foundation on the person's death, the insurance can be used to immediately redeem those shares. The charity doesn't really want shares of an operating business. They'd rather have cash. The insurance is there to provide the cash. At the same time, there's a capital dividend account credit that arises in the company from the payment of the life insurance proceeds. That CDA is not used when you redeem the shares. The charity doesn't need a capital dividend. They're not going to pay tax anyway. So the capital dividend account stays behind for the benefit of the other family members of the deceased shareholder.
So that final example around donating private shares is very sophisticated and can be a little bit difficult for clients to thoroughly understand. It's definitely a challenge explaining something that complex to people who don't work in the world of tax and life insurance. Could you take us through an example of how you might explain this to a client?
Sure, and you're absolutely right. If you don't have an example to show someone, then it's just words and they go in one ear and out the other, and people don't really get anything out of it. So I think for something like this, you can show it by using diagrams and numbers, just in general how the concept works. And so we'll do that now. So here we've got an estate. We'll assume it's an operating business. It's worth $4 million. The ACB of the shares is 0. And so essentially, if the client does nothing, they've got a $4 million capital gain on death. We're assuming no transfer of shares to a surviving spouse. The tax on a $4 million capital gain, again, depending on the province you live in, is $1 million, certainly more in some provinces, but we'll say it's $1 million. And so the net estate value in that case is $3 million. So that's sort of the starting point, the do nothing, no planning kind of approach. Taken to another level, let's assume that this same individual decides to donate, and this would be done through the will, decides to donate $2 million out of the 4 on death to a foundation. There'd still be that same initial tax liability of $1 million. It's a capital gain, it's taxable, it's not a public corporation, so there is a capital gain. At the same time, though, there's a $2 million credit, charitable tax credit, that arises because that was the value of the gift given to the foundation. The amount of the tax donation in that case eliminates the tax liability on death. And so at the end of the day, the estate has $2 million net because they started with 4 and 2 went to the charity, and the charity has the 2 that they received from the estate. So instead of $3 million of total asset value, which was the example number 1, the do-nothing approach, here we've got $4 million of total value, $2 million to the estate and $2 million to the foundation. So that's with some planning, but without life insurance. Okay, so let's take this example now and layer on a life insurance solution. So we've made some assumptions here about the amount of insurance is going to be $2 million. We know that because that's the amount of shares being gifted. We're assuming that the insurance cost is $1.2 million. So obviously we're making assumptions about how old is the person, what's their life expectancy. That's going to vary by client. In our example, we've got $2 million of death benefit. We've got $1.2 million of insurance premiums. When the individual dies, $2 million is paid to the corporation tax-free. Capital dividend account credit, which we're assuming here is $2 million, will apply. Now people will understand the capital dividend account credit is actually the proceeds minus the ACB of the policy. The ACB is a bit of a moving target. We don't know what it's going to be when a person dies. For the sake of simplicity, we're just assuming it's 0 in this example. So the full capital dividend account credit is there. So a $2 million CDA credit will generate, again, depending on the province, about $900,000 worth of tax savings because that CDA is going to be preserved. We're not using it right away to redeem the shares. The corporation is redeeming shares to a charity that's not a tax-paying entity, so we can make it a taxable dividend. There's still no tax paid. So the CDA credit is there for the benefit of the deceased's family to use after death. And so we're applying a tax rate to that because those are tax savings from what would otherwise be taxable distributions to the family members. So if you add it all up, there's about $3.7 million of net value to the estate there. There's still $2 million of value to the charity because they now have $2 million of cash instead of $2 million of shares. So that's a total net value between the two of them of $5.7 million. So we've gone from $3 million to $4 million to $5.7 million using an insurance-based strategy. So we can just summarize it on this final illustration. The do-nothing approach means the CRA gets $1 million and the estate gets $3 million. Maybe not the most desirable result because people don't typically want to give tax to the CRA if they don't have to. If they gift the shares without using insurance, the CRA gets nothing. The net estate value is $2 million. The charity has $2 million. If we use the insurance approach, and again the numbers will vary according to what the insurance costs actually were, but in our example there's $5.7 million of total value. 3.7 of that's the estates, and the charity gets the 2 they were always supposed to get, and again the CRA doesn't get anything. And so that has a lot of appeal to business owners typically.
Well, that was a great example of how to explain a really complex strategy to clients. Really appreciate you walking through that with us and for joining us, sharing your wisdom today.
It was my pleasure. Thank you.